Good afternoon, everyone, and welcome to today's Roundtable. The topic for today is the founder's dilemma. Can you chase unicorn dreams without bleeding cash? We have a powerhouse of panel founders today who have lived this dilemma in very different industries, from electric vehicles to co-living to fintech to edtech, SaaS, health tech. And you also have an investor at the table, Sumit Jain of 360Y, to bring a capital market perspective to this. So in the panel today, we have Shreesh Mishra, co-founder and CEO of Simple Energy, Dr. Nikhil Sikri, co-founder and CEO of Zolo, Lalit Vise, CEO and founder Bison, Colin Shah, co-founder on Charity, Yashwant Raj Parasmaya, founder and CEO 21K, Sumit Jain, senior fund manager and strategy at Mid-Stage Ventures 361 Asset, and Vineet Agarwal, co-founder Chirag. Good to have all of you with us today. Let's start with a fundamental question. Is unicorn dream still worth chasing? And Sumit, this question is to you because you're the only founder here, and we would want you in that hot seat.
You mean not a founder here?
So, is the unicorn dream still worth chasing, or should today's founders focus more on profitability?
I thought we'll do this a little bit later on the holy grail question, but I do think valuations are not worth chasing. My opinion is valuations can't be chased. Performance and milestones can be chased, and valuation follows. Right. So I think the answer is probably lying in the question itself. You are eventually chasing profitability. You are eventually chasing sustainability, and valuation automatically follows. I'd also add the nuance that today, more than before, valuations are getting pegged to public markets. So you can't get valued in a vacuum, right? You're going to put your public market lens, public market filter on all the time and see how you get valued by long-term public market investors. And in that case, there's not that much positioning you can do about your valuation because the numbers speak for themselves. The sustainability is all too visible in the numbers. So I would say the summary answer is unicorn, soonicorn, minicorn, they're not worth chasing because they come on their own. What you can chase is performance.
Right. Let's try that against the founder's experience now. Trish, coming to you first, you are in EV manufacturing and, that's highly capital intensive. So in a sector like that, how do you balance aggressive growth targets with financial discipline?
Of course, the industry that we are in is very capital intensive, from designing a product, developing, manufacturing, testing, validating, and then taking it to the market to sell to the customers, right? So there was a stage when we were also facing the same issue that should be focusing on more on moving towards the unicorn road, or probably focusing more on stability and profitability. So because since the last, I would say 2 or 3 years have been a little tough for the Indian startup market as well, we realized that we should focus more on the break even, and rather than not just scaling up, but looking at profitability. Even if I, let's say, sell one product, 2 products, or 2,000 or 20,000, the focus should be making money on that product rather than just burning investors' money, because investors' money is something that will probably end up at one point of time, or probably be held up because of market scenarios, global trends, and whatever the situation might come, right? So at Simple Energy, we have understood this, and we now are focusing on profitability and making sure that the products that we sell are not just value driven for the customers, but value driven for the business as well, making money for us. So I think that's the way that we're looking forward.
And how much do you spend on R&D?
So we have spent close to, I would say, $30 million. And continuously now we are focusing more on developing products built on the same platform. So we've built a technology, we would want to leverage it to build multiple products to cater multiple target audience, starting from, let's say, tier 1, going to tier 2, then probably rural areas as well.
Right. Nikhil, Kavanji, maybe not R&D, but your segment is operationally heavy business. How do you scale fast in your case without burning a disproportionate amount of cash?
So even if I go in the past where we were burning a significant amount of cash, it was not because the business is operationally heavy. It was more getting burnt on bad decisions, bad hiring, higher CAC, bad supply acquisition, wrong properties getting onboarded. So I think the bad business burns way more money than any other complexity. And this bad business is fundamentally a result of bad decisions which sometimes tends to get perverse. Because what you've sold as a valuation thesis, a lot of times as founders we have a habit of blaming investors, that investors are pushing us to run fast. But that's not really generally the case. It's a thesis that you've sold to someone and is underwritten a case. And if you deliver on that, no one's pushing you. And if you don't deliver on that, then it is rightfully so. So in those periods, I think the real reason for cash burn was bad business, not really the operational complexity of the business. I think the amount of tech that's available today and at your fingertips and at the speed at which you can build, even 5 years back, now with AI, so you can build it like a joke, but 5, 7, 8 years back, then also you could manage people, you could manage complexity, because fundamentally managing operational complexity boils down to rules, processes, systems, expectation setting, hiring, training. So there is a method to this madness, and that's not the real killer. The killer is your bad decisions. So I feel if somebody wants to scale fast, first scale slow, learn what are the right decisions, what are the right guardrails, understand where do you draw the line, understand the organic. So every market offers you certain organic rate of expansion and certain inorganic rate of expansion. So understand what is the organic rate of expansion, how much can you grow a month or a year in the right opportunity that you can capture. And if you go outside that percentage or that number or that quantity, what is the trade-off, how much you have to lose. So be smart about it. So first 1-2 years, whatever business you're doing, understand, learn the business, because most of us come from not exactly the same domains, although these days a lot of founders are coming from those domains because startup ecosystem has matured. Like when we started, I think 10, 11 years back, I was a doctor before that and just a ISB grad, right? So I knew shit about anything that we were doing. So we had to understand this industry from scratch. So my advice to anyone who is running operationally complex or non-complex, both cases, is first run the business, understand the market, understand what are good decisions, what are bad decisions, what is the right growth, what is the wrong growth. Because in some businesses, 100% is also less.
Walk before you run.
Yeah, walk before you run. And because some businesses, even 100% year on year is also less. And especially at early stage, base effect. You're too tiny. You should be growing 200%. And for some, even 50 is too much. It depends on the market, depends on the market players. For us, if I were to say, I think we finally found our rhythm into how much we can grow and we want to grow. And we are happy with that. We'll talk.
Is there no peer pressure? You operate in a sector where there are competitors. You have investors or others, saying that, you're not going fast enough. You're talking about scaling slowly. Do you come under that pressure as well?
So I'll just probably paraphrase my comments if they didn't land right. I'm not talking about scaling slowly. I'm talking about scaling optimally. So at different age and stage of life, you will have a different speed of scale which will not break you. It's like, if I give an analogy, you take a Maruti and run it at 200 ka speed, it will break. Every engine will go out. If you take a Ferrari and run it at 100, you'll feel like, I haven't really put it on the final gear. So you have to have that awareness and that cognizance of what have you and what kind of roads are you driving. You take a Ferrari and drive it on my Bomanalli and Magnampalya road, it will not go anywhere. If you have a smooth road and a Ferrari, you go at 200. No, that's much safer approach than going at 80 or 60 or 70. So there has to be cognizance of a car and the road being the market in this analogy and car being your organizational capability. So if you have cognizance of both of these, then scale optimum. And the answer can be 3x every year, 5x every year, 10x every year, or 30% every year. So that's what I'm really not recommending, is scale slowly, but make a very conscious assessment of what car and what road are you on. And on that, you will find a rhythm. Like till last year, we were growing fairly slow because our market was not, the co-living market is not very, very aggressively growing right now due to COVID and all, and post layoffs. Then we moved to hospitality. And hospitality, like if you take percentage, I'll grow 16x this year. Base effect, because the base is too small and the market is too large. Next year, I won't go 16x. I'll go, I think, 2x or 3x. So it's the answer is not one size fit all answer. Answer is your time and your age and stage. that should tell your optimal answer. And if you listen to that honestly, generally it's hard because our eyes get clouded by different things. And you talked about peer pressure. So coming back to that peer pressure, yes, there is indeed a lot of peer pressure. When somebody raises money, the first phone that you get is "Usne paisa raise kiya, aap bhi karo." And you have to know your path. इसका कुछ कर नहीं सकते. You just talk your way through it if you think that's not the right thing for your organization in that state.
Absolutely. Lalit, coming to you on the other hand, run a SaaS business, a retail intelligence platform. You are asset light in that sense. How do you balance the speed of scale? Are you also driving a Ferrari? You're driving some other form of a car, and how are you ensuring financial discipline?
Right. So we focus on a vertical SaaS or an enterprise SaaS business. And typically our capital spend or layout would be largely in what you call it as a customer acquisition or a customer acquisition cost, like a sales and marketing. Our sales is very high touch sales. It takes months, sometimes even years to do that. So investing in the right kind of AEs, right kind of sales structure, sales incentives, the marketing plan, marketing platform, account-based marketing and all of that. That's what the spend goes on. So very, very early in our life, and that is sometimes where investors help. And we raised money, I think, in 2030, first time. And I think my first investor kind of encouraged me to look at SaaS metrics or platform. BEP as Bessemer has a great literature around it. There's another gentleman I liked or followed called Christoph Jans from Point 9 Capital. So you might have heard about this rule of 40 and stuff like that. But one of the metric that we followed from very early in life is the CAC payback period. To just for people even like in a SaaS who are new, for maybe a SME SaaS, a CAC payback of 12 months is good enough. For enterprise, it can be up to 18 to 24 months. So very early days, we would monthly track that CAC payback to see if it is going far beyond 24 months and consistently. And in that case, what is not working right? Is it my qualification not working right? Is it my target market not working? Because we work as an enterprise SaaS, we work in a very small cohort. Like there are maybe few thousands of possible customers that I have worldwide that I'm focusing on. So it's very easy for me to figure out which of those thousands of customers that I need to get into. Another interesting thing about our business, ours is a reverse funnel. Because it's enterprise SaaS, once we acquire a customer is when the actual sales starts. It's about expanding my existing customers far more. Half of our growth comes from existing customers. So with those nuances, if you are able to manage that CAC payback pretty well, it is, at least according to me, it is fairly straightforward or simple to run a SaaS company profitably even. I mean, I sometimes keep on questioning why do SaaS companies even need to raise money for that matter. So no worries about valuations and who cares? If you don't need to raise money, you don't need to know your valuation till you go public. So if you manage that metric, those metrics pretty well, it's actually fairly relatively straightforward to run a SaaS company profitably. I think most of my peers with similar size kind of agree to that. I mean, I've met Girish and he also agrees that a SaaS company should be profitable. There's no reason a SaaS company should be burning money.
Coming to you, you run a business which is looking to serve SMEs, startups, and that also in the insurance space where there's a lot of regulatory compliance. You need trust building, you need to distribute at scale. So, of course, you're going after traditionally unserved industries. How do you scale such a complex product without burning excessive cash?
Yeah, I think burning cash, I don't subscribe to that term because I think for us at least, our initial years, yes, you're investing a lot on the tech part of it because the only way to kind of grow in a highly fragmented market, right, is to basically build the right tech because tech-led distribution is what going to help you to kind of get the entire, both from a distribution perspective and servicing perspective is what is going to drive profitability towards, the future. So I think, yes, in the first initial few years, we did invest a lot on the technology part of it because you are actually building things from scratch for onsurety, because we were looking at the SME market, we were not having any kind of a, how do I put this, any kind of a benchmark in India, because most of our peers are only looking at enterprise, right? And out there, it's more of a high touch point kind of sales. What we realized is that if we want to go after, a large market of SMEs, so stats say there are 63 million SMEs, only 10% of them, that also on the higher side, 10% of them actually provide any kind of a health benefit to their, employee. So now if you have to go behind this kind of market, you have to really rethink our entire distribution, right? So it was not about sending our FOS on the field. In fact, we had the smallest acquisition team today also. We have only about 34 people who are acquiring businesses, and we have about 8,000 organizations working with us. The way we cracked this is that we did very intelligent partnerships with large supply chain networks. We did, integration with SaaS companies who are actually going behind SMEs. So one of our partners is Tally, right? So Tally basically has empaneled us to work with all of their distributors for their employee health benefits. We've partnered with the restaurant aggregators, where we kind of work with their restaurants, and we've created standardized plans. So we built our entire technology to create standardization on the product side, and that has helped us to kind of now see that initial and like Lalit said, right, has actually helped us to drive a much higher LTV to CAC, because we see close to about 80% lower retention today. And that has only happened because we don't kind of create, complex products and solutions, right? We've actually simplified all of these products, and we have also created our entire layer of claims and services, right, which is like the moment of truth in our business, again completely digitized. So we have a lean team of about 300 odd people today, servicing close to about 8,000 organizations and 1.5 million users today. So yeah, so from that perspective, we have invested a lot on the technology part of it, which now we are seeing results, because we have like a retention rate of 80%, which is vis-a-vis 65% in the normal market, right? For brokers, it's 65% lower retention. We see 80% lower retention today, only because we've been able to kind of iron out all these cracks in the service part.
Interesting. Yashwant, coming to, while Uln has, started, Easy's collaborated with others in the sector, I don't think collaboration for you is possible, because you're looking at upending the education sector by providing online schooling, which has massive potential. How do you scale without overspending, and how are you doing this now?
Certainly, one of the things that has really worked for us is, getting the product right in terms of the platform. Because I think early on we understood that the problem that we're trying to solve is far bigger than what we had anticipated initially. I think that what, as a founder, keeps us driving, right? I mean, what is the scale of the problem that you want to solve, and how quickly you can solve? So if you could understand the customer and the consumer behavior right, and solve for that problem at scale quickly without overspending, then you're definitely, they're out there in terms of scaling and growing much bigger. So first, when we realized that the problem is really the quality of education, we started building a great ecosystem of teachers, parents, learners, where the learning experience leveraging technology could be seamless, could be something that is valued by the parent and the customers, and that's what helped us to scale. Initially, we did make a mistake of, trying to buy growth by investing a lot in terms of the marketing spending, the initial capital that we spend. I think that's the lesson that we learned, that you can't buy growth. You can't invest investors' money in fueling growth, which is not going to be sustainable. So unless you've not solved for your CAC, for your LTV retention, and create a community flywheel, the model is not going to work. I think that's one of the biggest reasons why we've been sustainable, profitable today, is because, of our focus on managing fixed versus variable cost. So we not only solved for the acquisition problem, but also had a very hawk eye, insight in terms of converting most of a fixed cost to variable. So for example, most of my tech cost is a variable cost. We leverage a lot more of SaaS solution rather than building it in-house. Until we achieve a certain scale, we don't see a merit in terms of investing and building our tech IP. So that is really about this per year.
Right. Many coming to why he talked about, the mistake of trying to buy growth. You operate in a space which is very nascent and new in India, the alternative fixed income investments. In your case, then, how do you scale without overspending on customer education and acquisition then?
So see, any new product, I think education and awareness is needed, right? But if the product is a new investment product, the third component is trust. Okay. So the way we look at this is that, education and awareness, yes, you can spend a little bit of money, to ensure that there is some awareness about product. But the trust piece is something that, irrespective of how much ever you spend, it takes time to build. Okay, so the way we look at it is that, the first piece is to have a very, very strong focus on, the customer, which is the CAC, which everyone is talking about. Okay, so for us, it's that, we ensure that we break even on the CAC in less than 30 days of acquisition of that particular customer. We tried, spending more, but what we saw was that, the CAC starts breaking after a point, right? So then what it means is that there are some things which only time can solve. Okay, irrespective of how much amount of money you pour in, you need time, right? So the third piece is now the trust piece is something, especially in investment business, it's word of mouth, and that is something again you cannot buy, right? Today almost 30-35% of our customers come from referrals only, and which we double down on that because the retention is very high. The wallet share is very high in those cases, and that is something we have been doubling down on from a strategy perspective, and that has helped us have very, very low burn numbers, and the CAC to LTV is very solid. So these are the things that we look into basically, rather than just increasing heavily on performance marketing, which cannot be a long-term strategy. Yeah.
Interesting. So we're coming to founders often talk about they feeling pressurized by their investors that you need to scale. And how do you balance now then ambition and financial discipline? And is there a matrix where you can determine and say that, okay, fine, this is the kind of growth you need to see, and it's fine, and for that, this much amount of cash is okay. And we've also heard, panel members talk about certain mistakes they have made during scaling. How patient are investors when it comes to mistakes like these? And you go and tell them that, okay, I think you need to give it a pause maybe.
Yeah, I think a lot of, answers to this particular question were somewhat hidden in what Nikhil was saying earlier, that if you've truly found product market fit and then you start backing it with risk capital, is when it starts to make sense. Now remember, our asset class, by the very definition of it, is not trying to back companies to grow at 10, 12, 15, 20%, right? The idea behind raising venture capital or growth capital is to somewhere create a little bit supernormal growth, and which is where the value of the capital is coming from and the kind of returns we are expected to generate. I think the difference between is that money going down the drain versus that money going towards building something is really, I think, the distinction we are trying to create. I think some of it comes out in metrics that we try to track, right, which is showing whether the money is going towards the right ends. One is stickiness, right? Whether it is enterprise customer or a retail customer, stickiness of cohorts, right? So whatever you are supplying to the market, is that valuable? Is that being used? Is that useful to a certain cohort? Second is there are some holy grail metrics that we as investors look at all the time, right? So contribution margin, right, which is basically a simple way of saying, is every transaction, especially for retail businesses more relevant, right? Is every transaction you're doing, profitable, or there is a leap of faith that today I'm not creating profit, but as the customer comes for the third, fourth, fifth, 10th time, I'm going to start making money, right? So In some cases, that story is hard to sell, and investors find it hard to buy. In some cases, it is maybe indeed true. Maybe it's true for a use case like quick commerce to say, if I spend a lot of money, getting a customer sticky, in a sticky way, over a year and a half, 2 years is going to pay me back, right? Lalit talked about how he differentiates between enterprise SaaS and SME SaaS. You can be patient with enterprises in getting your CAC money back for a couple of years, but you can't have that leap of faith with SME SaaS type customers, right? So is your fundamental holy grail metrics actually in the right direction? Is there stickiness in your offering? And I would say, are you showing that there is operating leverage being created in your numbers as you scale, right? So, at X scale, you're producing some numbers, but at 3X, does it become much better because your fixed costs get distributed over a much larger scale? Those are very obvious metrics to track. And when you start seeing those numbers, you can actually usually tell whether investors' money is being spent well or it is just being spent to artificially create scale for all the perverse reasons, right?
Right. Shish, EVs generally need, a longer duration, a longer bit. What are your views then on getting to that unicorn stage? Your journey probably would be longer if you're chasing the unicorn status compared to, say, a SaaS startup. And do you think investors in your space is willing to, long-term bet?
I would say, as you rightly said, because in the EV industry, you're talking about a physical product which people would be riding. You're talking about a product probably somebody would be using to go to their office, riding at a speed of 80, 90, 100 kilometers per hour. So it takes a lot of time to test, validate, and then probably take it to manufacturing and then sell it to the people, right? So I would say we have met a lot of investors. We have been rejected by a lot of investors. A lot of investors have put in money as well. So every investors of course, after the COVID, the mindset has changed, but every investor has their own particular way of looking at it. Some might say growth is the most important thing. Some might say that profitability is, right? But now, since the last couple of years or 3 years, I think the private market investors have also understood that the profitability and building sustainable growth is the most important thing. And that is what we are doing. For us, unicorn status is something that is not at all that we are looking at. Probably once we go to the public market, then the public market would tell us what is the right value. So for us, the focus is to build products which are creating value for the customers, creating value for the company, and break even as soon as possible. Because in our business, I would say the economies of scale plays a very important role. The first scooter that we produced was around probably 2.5-3 lakh rupees, and now we are doing around 700 to 1,000 scooters a month. We brought it down almost by 40-45%, and by this year end, financial year end, we are looking to break even. So I think that's the focus that we have, and I think all the startups or all the businesses have shifted their momentum, shifted their focus towards being profitable, being sustainable, rather than just focusing on valuations or unicorn or decacorn, whatever status that's coined in the market as of now.
Right. And has it also helped that, there have been players before you we've gone through that process, and you probably don't need to spend so much on, say, a customer acquisition, because, there are people who are already aware very much about what an EV does or what a...
Yeah, I mean, that definitely has, because if there are players before you, they have helped you educate the customers that you don't have to put in a lot of effort, time and money, right? So, of course, the market has now matured. When we were starting, it was close to 1% of the overall two-wheeler sales. Today, it's almost 7 to 8%. So it's like in 5 years, 6 years, we have seen 5x, 6x growth of the complete market. So that definitely helps. And it also helps in creating confidence in the suppliers. For example, let's say if there was no EV ecosystem and I would go to a supplier, tier 1 supplier, and ask them that I would want to build something, I would be probably starting from 100 a month and then probably look at 10,000, 20,000 a month. They would not be taking us seriously. So for the players who have been there in the market, they've helped create the ecosystem as well.
Right. Nikip, you have other players in your ecosystem, and I think all of you did find it incredibly tough during the COVID period. How are things looking now? You did mention that you've branched out to the hospitality sector as well. Are you looking at diversification in a way so that future growth and scale is also ensured and not just dependent on one sector, maybe
Sure.
one segment, maybe.
Yeah. So I think COVID did accelerate the vision, but since I think 2017, the decks that I've been circulating, that's exactly we've been sort of talking about that what we are building is operating in a tech stack at an abstract level, which you can apply on any place where people live or people stay or people even for that matter work, where there are people and there is a space, people in space correlation. So we are operating system and a tech system can really work. So COVID forced us to accelerate that entire vision. In that process, we moved from just co-living to even student housing. Student housing, we scaled aggressively. We have now 18 universities, 45,000 students who we manage on campuses. Then we moved to the another segment or category, what we call, which is short stay. And short stay, maybe we have different brands for budget as well as premium brands. So in that sense, it did really help. So every cloud has a silver lining, no matter how bad or dark the cloud is. So it did push us to accelerate a lot of things because time, energy, no matter how much we say, are always constant, no matter how many people you can hire. But as an organization, as core set of people who are making decisions and driving the organization, there is always a finite amount. So when co-living sort of slowed down a bit, so this gave us time to accelerate other segments. And that has been a very rewarding experience or a very brilliant silver line on a very, very dark cloud.
Right. Lalit, SaaS founders often have this dilemma of choosing logos, which I presume is, a little bit more expensive versus, optimizing for your, customers, customer lifetime value. Can you highlight some of the tactics like premium partnerships and, what are the different aspects levers that you use and, is customer acquisition then, how do you keep CAC under control there?
Right. No, thanks for that. Before I answer your question, I just wanted to add something to what Sumit had said about when you asked about the pressure of scale and ambition, this thing. That's the founder's point of view, and I think we will agree too. One of the things that he possibly wanted to mention but could not mention was also something Nikhil had referred to some time back. Investors invest using a certain thesis, and they would want the founder to deliver out that thesis. And sometimes it may happen that there is a divergence afterwards. But what I have seen, at least, and we were fairly lucky to have a very long-term investor, but even some of other friends as well. This eventually, once the investor is on board, it's actually a partnership. So while you do need to have an IRR of whatever 30, 40, 50, 100%, that's the ambition. But that ambition can only be true when there is a partnership between a founder and that good investors typically realize that when this is eventually a partnership. So it's not about putting pressure on the founder. That's not going to yield you anything. It's about realizing the realities of the business, the market, the opportunity, the team, which car, which road. There's this understanding. Maybe I signed up on a different thesis, but reality is different. Maybe I thought it's Ferrari and empty road, but what I have is a Alto vehicle.
Yeah, sometimes you don't know what lies there.
But then once you realize that this is now it is, and then eventually if you have, there is a mutual respect between a promoter and the investor, then it forms a partnership. Then the question becomes that now how do we go about doing this Ferrari on empty road, or how do we navigate this particular situation together? And I think that is often underestimated because especially VC investing being such a risk capital, it is nothing, there is no formulas to do that. The only successful formulas have been the long-term partnerships that have been formed between entrepreneurs and investors, which eventually deliver value over a period of time. That was just my 2 cents on top of what Somasheep asked about. Now about the actual question about how to keep CSEs in checks, and you're absolutely right. So one of the things that helps, I think, how do I put it? It's a slightly controversial opinion. It is believed that in India, a lot of entrepreneurs are tech entrepreneurs and they need to be taught about business. And hence, there is a lot of playbooks written around how the whole inside sales machinery should work, how marketing machinery should work, how AE quotas should be done, and how. And there is a lot of playbooks written, and a lot of startups are trying to follow that way. We took a slightly diametrically opposite view, and I'm a tech entrepreneur. And I said, because I can only code, the only thing I'll try to focus on is trying to build a better product and let the product speak for itself. I honestly was very naive. I had no idea about TAB. It's only the investment. Whenever I'm creating a piece, VC decks is when I start looking at TAM. Otherwise, I was generally naive about it. So we said, okay, look, I see a problem and I try to solve the problems and try to solve in the best possible. We talk to users and try to find out if the users are facing problems. And so we did very interesting things, like, for example, very early days, as I said, ours is a very high-touch business. And our users are like his Patri Pass semi-literate, so to say, retailers, field executives and all of that. Very initially, we started distributing these certificates to say, you're Bizom Pre. And in our industry today, almost 20% of the field force of India FMCG uses Bizom. And they write Bizom in the resume, saying skills Bizom. It's a little bit like tally of that particular ecosystem, right? So when you're trying to hire a field executive, the guy is written the resume, trained on Bizom. So the guy who's looking at it says, what is Bizom? Let me figure out. And that becomes my channel, or that becomes my funnel. In general. So we partnered that way with distributors, we partnered that way with strategic. So all the ecosystem players who have experienced Bizom and actually have derived value out of it ended up becoming our evangelizers. Over a period of time, when we became a market leader in that particular space, we started aggregating our views or our insights of what is happening. So today, Bizom knows what India eats, what India drinks, what India washes their hair with, and what almost 20% of India's FMCG flows through Bizom. So we started utilizing that insight in terms of publishing free reports for industry. And some of the media publications started taking those reports and putting it up in news. So if you look at now any commentary on FMCG in India, it typically will quote Bizom, not Nielsen or Kantar. Because Bizom knows what happens in 15th of August, how did consumption change? Bizom can tell you on 15th of August, whereas Nielsen would be waiting for another 6 months to figure that out. And that helped us, because then suddenly we got also access to the boardroom. So being very product focused, very engineering focused, just trying to fix our products, just trying to please our end users, customers, or larger ecosystem itself has given some level of network effect for us to reduce that CSV so much. So much so that even today I find it very hard to hire a good AE, so to say. I don't know what to look for in an enterprise hunter and get very disappointed when they don't know basics of tech. And in spite of that, we have survived, if not tried. So I think, I heard about it from Vineet as well, about trust. Initially, Nikhil spoke about organic growth. And all of that eventually point to that simple thing. If when in trouble, focus on product. The CSC will automatically go down. That's the holy grail.
Cool. What is your holy grail, or North Star, if I may add? Many insurtech startups, they chase evaluation, and you're also, one of the early ones in this segment. So getting to a unicorn status would be wonderful, I'm sure. But how do you achieve, sustainable underwriting profitability? And is it tougher in the segment that you operate in?
Yeah. So first, we have never chased valuation in any of our rounds. Okay, right? If anything, we in our round in 2021, right, we were happy to take a slight bit of a haircut on our valuation, because we knew that the markets are unsustainable. The investors are going out of their way to please founders and give them random valuation. We never targeted those things because we knew that valuations today will not sustain tomorrow. In fact, there's a good possibility a lot of unicorns might become Soonicorns, and that is bound to happen if you're like cheaping valuation.
Or babycorn.
Or baby, right?
And then get pride.
Our thesis was always that the market that we're going after, right? We had to ensure that there is a playbook that we are able to create, because we are basically category creators. We are not going after renewal market today, right? We are actually going behind companies or organizations or business outfits who are actually purchasing health benefit for the first time. 80% of the folks who purchase from Onsurety today are purchasing health benefits for the first time, and hence our ability to understand the business, our ability to figure out what are the right parameters, right? Because we don't do any kind of a health checkup, all right? So obviously, whether at the point of beginning, we don't have any kind of a medical data, but what we kind of look at is the kind of company that they are, how long have they been, at it, what has been their growth in terms of their, employee size, what is the age group, right? So on and so forth. And that can basically become the backbone of our, our ability to understand risk of the customers that we are going after today. In fact, SMEs are a more profitable segment than enterprises, because when an enterprise just talks about their renewal, you'll have about 15-20 people lining up out there ready to kind of just get a logo and not build a sustainable book, right? But in an SME, the SME has to actually go to 10 places and figure out, will I get a product for my company or not? And that is the kind of company that we go after. And that is why we've seen that an SME business is always going to be more profitable than a large enterprise business. And hence for us, yes, our entire tech was kind of focused on saying that how do we start looking at who's our right ICT, right? And how are we kind of going to be understanding this business better, so that even in the first instant itself, right, we are able to go for unit economic positive business. So none of the business that we have written today are unit economic negative business.
Right.
All right. So I think that has kind of been our holy grail, that unit economics positive business is only the one that we will bring on you, right? And we will not renew a customer who's not unit economics positive for us. So that has been our holy grail, that valuation is never been something that we are chasing. Like Sumit rightly said, that let the public markets do that, decide that at the end of the day, what you need to ensure is that if your unit income is positive, that's what will differentiate you in your segment at the end of the day.
Yasha, coming to, if I had to borrow from a very popular song called Polar the Broken Dreams, I think EdTech is one such space. So how are you going about doing, building a sustainable model which is trusted both by parents and regulators, maybe?
So you're right. I think the EdTech has faced its thing, and probably it's because of one or two companies where the EdTech sector were a bad name. But I think the problem that we're trying to solve is still real. I think nobody has really solved the problem, right? And that's what matters. Whether you call it in what if people have gone to an extent of rebranding EdTech as Learn Tech or School Tech and other things. But fundamentally, I think what is important is that the problem that one is solving, as that will solve on at scale. I think that's where we are focused on. So if you look at the schooling segment that we are operating, the schools haven't changed for over a century. And I think that's a great problem that we are seeing in terms of the pedagogy, assessments, the validation of the entire schooling, more so in the age of AI adoption today. Is this learning experience where a child spends 16 years of his lifetime, is that going to add meaning and value to the child's entire learning journey? I think that's a big problem. And, out of my experience of 25 years in the sector, I know that the physical schools, which are the mainstay of the complete segment revolves around the physical school, are not capable or not positioned to solve for that particular problem. So from that perspective, I think, the EdTech or the online schooling space is going to be fundamentally still be relevant. Because then the problem is much, much bigger, because out of 30 crore student population, half of them don't have given access to the secondary or senior secondary schooling. And there is no way that the government or the private investment can solve for this particular problem of giving access, affordability and equity in terms of the learning opportunities to complete the schooling experience from where on the career and other particular starts. So I think the fundamental aspect of what we're trying to solve will leverage. I mean, we know that fundraising is going to be difficult being in the EdTech space. A lot of investors have shied from investing in the EdTech. That's true. So we have dropped in a bootstrap DNA into our entire ecosystem of running. So we don't think that, we are startup in that sense. We want to operate as a bootstrap. I think what was mentioned about unit economics is absolutely relevant. Building the trust, the quality of the product, the platform, renewal, working on the community flywheel, the renewals hand be thrown because of the word of mouth campaign becomes a very sustainable. But we're also confident that, probably in a year or two, the market is going to open up, the opportunities will come up where we will be able to invest far more in terms of re-looking at the curriculum. For example, acceleration is a major concept which is coming along with personalization and flexibility. So raising funds for some of these concepts where you're building the stack for the future growth, I think that's where the investment will be.
Very, there are many fintech startups who struggled with regulatory compliance, and that has slowed both its sustainability as well. How do you ensure you're on the right side so that you don't get any regulatory surprises? There are different regulators, SEBI, the RBI, while they all want to drive innovation, but there are compliances. How do you stay on the right side?
See, there is this famous saying, I think, for all startup where it's that innovation comes before regulation, right? So you tend to innovate and there's a lot of time, regulations are catching up, right? So it's not that it's not that the founder don't want their business to be non-compliant. It is sometimes it so happens that there are no regulations, right?
Classic
Yeah.
case yesterday.
Yeah. So, but yes, see, as much as possible, the way we look at our business is that, whatever existing regulations are present and whatever business that you are doing should be compliant from a day zero perspective. Okay. But yes, there will be some innovations where, although you might be talking to the regulator on a daily basis, there will be non-existence of some regulations where you need to innovate and work along with regulators. Okay. Today, at least in fintech, I can say both RBI and SEBI are very, friendly. Okay. They have created unique groups where, you can do sandbox testing, you can discuss ideas with them, you can, send your proposal. So you get some cues as to the way they are thinking, and then you start building your business accordingly. Okay. So I think the more you are in touch with regulator, the more you are in touch with the ecosystem, I think it helps your business. Okay. And as a business, we have always been, whatever the existing regulations are there, you please be compliant from a day zero perspective. Else it becomes very, very expensive in the long run. I would say that is the biggest risk of any fintech business today. Okay. Of not being a compliant business criteria.
Right.
Yeah.
Sumit, we could really talk about one risk. If you want to add anything on that, please feel free. But, the other question that I had was sometime back, we all heard about the funding winter. How has that changed, if it has at all, your investment approach? Are you, backing smaller, fewer, stronger companies? How have things changed, if at all?
I can tell you about it from the perspective of a mid-stage investor, which is the area that I focus on. I think the winter is over. From what I can tell, even on the early stage, the winter is over. The kind of companies that are getting picked up now for investment are far less vanilla. So you have to be able to innovate and do something far more interesting rather than do vanilla stuff, which was getting funded 2021 and before. But if you have a good quality business across sectors with reasonable economics, I think there is plenty of capital available from mid-stage onwards, right? As you can probably also tell, there's plenty of appetite also from the public markets, and that sometimes flows back into late-stage and mid-stage investing. So, good quality, difficult to build businesses, non-vanilla businesses are actually attracting plenty of capital from my perspective.
Right. Sri, if I can continue with the same question, did you have any impact of that funding window? Has that changed anything for you? And I think it can, everyone in the panel can answer that.
I mean, yes, it did. When we were going through that phase, when we were going through that phase, it was like we literally had almost, I would say, 3 months of cash, and being a very capital intensive business, we went through a very tough stage. But the way we focused on building the business was to build our business independent of external money coming in, right? So we pivoted from not just being a company which is focusing on electric scooters, but also on products, the byproducts, just as motor controllers, battery packs, and other stuff as well. So that is how we got some additional revenue, and we started building on a different revenue stream as well, not just focusing only on electric vehicle as a product, but the components that we have designed, developed, and now manufacturing in our manufacturing facility to generate revenues from them as well. So that helped us, and at the same time we understood that we have to be as frugal as possible, as less input as possible into the business, and getting maximum output of it. And that is how we were able to sail through that tough period, I would say. There were times when we were not able to pay salaries on time, and we were very lucky to have the right set of people, not just investors, but also the team members who helped us build the company and the business, that they stayed through us through that particular rough patch. And today, now we are 25 stores live, and now almost opening 85-90 stores by Diwali. So I think that affected all the businesses that were dependent on external money, and that taught a very tough lesson to all the businesses that were focusing on not building profitable business, just chasing valuations, or probably looking at scaling up faster. So that's definitely helped us understand the way that business should be running.
Right. And they will also change the 3. I mean, you had a 3-month window. You're saying now you have a larger window of funds.
Yes. So we raised, post that pay period, I would say we raised almost close to $25 million. That has helped us scale to the level that we are today. We have, as I said, that we are selling in multiple cities, now expanding to other parts of the country, and focusing on profitability rather than valuations. Just focusing that the products that we sell, we make money out of it. By this financial year end, we will be breaking even. Then probably looking at a public market listing. That is when the valuation actually comes into the picture. Otherwise, it's all on the paper. That's it.
Nikhil, how did you navigate
The funding winter.
Yeah, I mean, if there was any change at all.
No, I think we all are how we react to seasons, right? When there's winter, we put on jackets and we put on sweaters. So that's unit economics, profitability. And you will see once spring season comes, everyone will be back to the same thing. So there is a joke in real estate financing that real estate developers have a very low short-term memory. But the best part is their financials have even shorter. So we'll all forget once liquidity hits market back in 2-3 years. You will see hundreds of companies burning money like there is no tomorrow. Hundreds of investors putting money to burn. People will be scolding entrepreneurs that you're making money, you're wasting too much money for growth. So it's cycles. I don't think anything has fundamentally changed. Sometimes, yeah, like when LTCM crashed, there is a volatility curve with the smile changed forever. So some things leave such big scars that things change forever. But I don't think this was that big an impact. So people will forget. So how we also managed? We managed winters through sweaters. And we bought the sweaters of unit economics. We are EBITDA positive. And probably this year we'll go PAT positive also by next year. And we have decent money in the bank. So we have technically infinite runway per se. And we will also one day hit capital markets or public markets, I mean. So same thing with a different twist a little bit. But winter is on, jackets are on. Like Sumit said, winter is going. You will see very soon jackets going off. And people wearing in their t-shirts.
Yeah, the winter is come. Yeah. But Lali, winter, summer, spring, what's for you?
So actually, I need to learn from Nikhil about this whole winter jacket, summer cap thing. Because I did as an entrepreneur, I do think I learned yet how to time this whole funding. We raised money on May 2020 when public markets were trading 50% discount. We again raised money last year. And so because we raised money in 2020, when 2021 everything was getting floated, people were getting 30x multiples. We already had so much cash in the bank, we didn't need the money. So we couldn't raise the money. We couldn't time it to the market, so to say. And that's something we need to learn. But the larger point from that experience that I learned, we back ourselves saying that we always raise money during the winters. Is what Sumit was earlier saying. If you have a quality business, with a decent unit economic and hard businesses to build with clear moats, there is never a win turn away. You always would be able to raise money. But obviously, as entrepreneurs, you should learn to time because then you will get cheaper money, essentially.
Or at your terms.
Yeah. So your terms, again, if you are good unit economics, you can make it always your terms. But the valuations is something you cannot really do. You can get cheaper money in lesser equity dilutions if you then time the whole thing properly. But in general, as I said, if you're building a good product market fit, iteratively working on it, there'll always be money. There'll always be capital available. That's my fundamental. At least in a tech first business, they have to be product led. There are other operation led and other businesses, but not.
What about you? Yeah, so we had the simply raised money in the funding winter. There he goes. So
They're all quality business.
yeah. No, but I think what worked for us is the fact that because we've never been in the catch up kind of a business, we are always a category creator of business, and unit economics are always positive. It kind of helped us to kind of differentiate ourselves in that particular funding winter. In fact, we raised in 2023 close to about $24 million. This was led by IFC, right? And I think the only reason why an IFC made an insurtech investment in India was because of the fact that yes, there was an impact. We were unit economics after packing it up, and luckily, that's what we never had to let go of any employees during the funding winter, right? We in fact we made sure that we were extremely improving when people were burning more huge amounts of money on performance marketing. We said we'll not burn money beyond performance marketing. We'll rather go partnerships, which were actually either almost free of cost or 1/10 of the cost of performance marketing. And we kept kind of making sure that whoever came onto onsurety stayed back in onsurety. That means we had to kind of able to drive our NRR metrics and not always just go behind new business application, right? So I think for us, we were always prepared for a funding winter from day one because we knew that there were going to be cycles, and we always made sure that growth did not come at the cost of unit economics. So I think everyone at onsurety will always think about unit economics first before picking up any licky, before taking any kind of a decision, right? Be it a marketing decision or be it a acquisition decision or be it a retention decision. And I think that has always helped us to ensure that we stay true to our vision and we never kind of moved away from our ICP. That kind of actually helped us in any of our discussions with potential investors, because a lot of our peers started with SMEs, landed up with enterprises, but we started with SMEs and we continue to be there.
Even I totally relate with what he's saying. Our journey is also similar. We did raise before this 21 cycle, and then in 23, only focus is unit economics and the not compromising on the TG. Okay, so that has something which has helped us till date, and a clear focus there helps you. I mean, otherwise there you keep on burning. I mean.
What here? Yeah, I think our learning was very simple. Keeping the parameters basic and simple, right? So I think what we've learned is that you don't scale because you've raised funds. You can raise funds because you're scaling. I think as long as there's a business independent of funding, if you are able to scale, there's a market potential where unit economics and all the business function of business, right? You'll be able to scale and you'll be attracted. I mean, today I know that whenever I need funds, at whatever point, I have the capability to raise the funds. There's enough capital available, for the right set of companies whose fundamentals are right in place, whose market fit is absolutely there. I think that should market corporate.
Right. So, the interest of time, last question to everyone. Sumit, starting with you, founders on one hand are generally asked to build long-term sustainable business. When it comes to investors generally have a limited time period within which they want to see an exit. It might be 5 years, 7 years, 10 years down the line. So is it a dichotomy between that and, how do you reconcile between the need to build, institutions that last long and also investors who see meaningful returns?
Yeah, I think I heard one of my fellow investors put this in a very eloquent way. The journey of a startup is like a train on a smooth track, hopefully a smooth track. The passengers can keep changing, right? So very often, you can have early stage investor go from, I don't know, Bandra up to Mira Road, and then the journey after that, there could be a different set of investors, right? So ideally, the liquidity of the ecosystem should allow for the cap table to be, changing, rotating, depending on the kind of capital the company needs and the stage of the company. And it does not necessarily impact the outcome or the journey of the company itself, right? They don't get sold too fast. They maybe don't IPO too early, or they don't IPO too late, or whatever it is. I feel like the ideal situation for a company is they find the right investors for the right stage and hopefully churn the cap table for the next phase of the journey.
Right. Sheikh, coming to you. So how important then is partnership, both with investors or maybe the ecosystem at large, which can be, governments, infrastructure players, maybe the ones who provide charging infrastructure and stuff like that. How important is that, and how you plan to go about something like that?
When it comes to investors, it's like, I would say, a marriage, right? You have to find the right partner because you'll have to spend a really long period of time and go through ups and downs. So it's like that. So you have to find the right partner, and that is when the story comes for all the startups. There are multiple set of investors that you reach out to. Some of them reject you for different reasons, and some of them accept you and invest in your business, right? And similarly for vendor partners as well. We believe that any company should focus on people, partner, and product. So these are the 3 P's that we focus on. And to build the product, you need to have the right set of partners, because everything you will not be manufacturing in-house. You have to get it something from some other vendor. And then the people who believe in the vision and also work towards building the product that you're trying to build, right? At the same time, government, because electric vehicle is an industry, if I talk about, government had to provide subsidies to make sure that the adoption of the electric vehicles is getting to the people. And today, the subsidies have come down to almost like 5,000 rupees a vehicle, and there was a time when it was almost 60,000 rupees a vehicle, right? So businesses have to be built independent of subsidies, because that's something that's temporary. But at the same time, whatever is available, you have to ensure that you cash onto it as much as possible. At the same time, build a stronger partnership with all the stakeholders, not just vendor partners, the customers that you're selling your product to, that you're servicing on a daily basis. At the same time, with the people that are working for you and probably have worked with you in the past as well.
Right. Nikhil, you have been through many cycles. You've seen your ups and downs, the boom and the bust. How then do you build smarter companies? Is it a strategy to it? Have you figured that out?
I will borrow this from Thomas Alva Edison, that I know 10,000 ways in not how to build a company. And we had to find out the one in which you can for sure build a company, or rather the answer is it's very contextual. So there are different business models, different people, and the more contextual and more authentic the answer is, the higher the likelihood of the answer to work. So if somebody copies what I am saying, very highly likely that will fail. So you got to decide what are your life priorities as a founder, as a founding team. What is it that you're looking from this venture? For philosophically, what do you want? Once you have that cleared out, then what is my market? What are the capabilities, skills, and strengths do I have? What is the market at which this merges the best? What is the market macro factors growth scenario? A lot of times we miss out on the macro factors, and because we are so, like I give early stage entrepreneurs an analogy, कि हम ना सर पे कफन बांध के निकलते हैं, वो कफन धीरे धीरे स्लिप होकर आँख के ऊपर आ जाता है, एंड वो आपको कुछ नहीं दिखता, दीवारों में सिर मार रहे हो. So you are just like blindly going here and there. So staying objective, managing, balancing passion and ambition with objectivity. So there is, I don't think, a single answer that anyone can give, that how to build a successful company or a successful startup. There are a lot of things that you can avoid which can for sure kill it, but how to build one is a mystery that is a very multifactorial equation that really boils down to that one person, one time. Like I earlier used to read and listen a lot to Steve Jobs and Kotak's and all these guys, and after a while you realize that their life had factors which are very different from my life. they had challenges which are very different from my challenges. They had opportunities, people they can hire or they can build with, or times were very different. So there can be no second Steve Jobs, and there can be no second Nikhil Sikri. So we all have to find our own paths, and those paths are fundamentally led by introspection and objectivity, and keeping your objectivity of keeping your macro and external environment open, and you will get somewhere. And that somewhere, unfortunately, no one can say how big or small it's going to be. That's going to be when the time comes, and you just have to be ready for it, because opportunity just comes and like slightly knocks and walks away. So you have to be ready when there's that slight knock, and you're like, please come in. So that's the answer on how one can, very abstract and generic answer. I don't know if you're looking for a generic one or a specific one, because my answer is that there is no specific answer. There is only generic guideline that you can give on how to do, but very specific things which one can tell what not to do. Like if I get into the list of things not to do, that's a very long list outside scope of this conversation. Not to do, I can tell 50 things or 100 things or 200 things to people. Look, if you do this, then for sure you're not getting anywhere. Like I've been able to so many times pick up founders. I will meet for half an hour. I'll be like, he will shut down in 1 year. He will shut down in 2. He will shut down in 3 months. And 95% times I've been right. Because I don't know how to pick up perhaps like the middle path. So like Warren Buffett says, I can pick up the best, I can pick up the worst. Middle, I don't know. So the best also shows those signs and ripples. They're like everything is ticking. Worst also you can easily find. Middle, God knows, it's destiny.
Right. The part of a company, especially in the SaaS space, many think of going global. How important is that? Or is that even needed, or is it wiser just to prove your material in the domestic market?
Right. So again, we have been extremely successful in India market, which is possibly one of the only company who's scaled to that level just to selling to Indian customers. So my answer is actually biased because of that. I do think there is a large market in India, and it makes sense to build for Indian companies, Indian customers, and hence make and there are far more opportunities. And let me put it that way. When we started in 2012, it was really foolhardy. Like I said, I mean, I did not know what the TAM means. It actually was the case. There was no TAM, and I was trying to address a market. So opportunities were limited. But over the last 12, 13 years, what I have seen is the market itself grow, the customers itself evolve. All this cloud, mobile, the infrastructure, Geo has sorted out a lot of this infrastructure in terms of internet and other stuff in India. So it's I think it's known fact across all now SaaS entrepreneurs that India is a pretty much a viable market, whether you look at it as SME, mid-market, or even and where we focus on as an enterprise. And we are actually we specialize vertical SaaS, and we believe it's viable there as well. But I mean, there is no necessity for a SaaS founder to go overseas. But again, eventually it remains with your PMF and what do you care about, right? If the problem that you care about is a problem of a Western world and something that you can totally relate to, then you should go and solve that problem. My humble suggestion is that if somebody is focusing on a problem on America, one should be ready to migrate to America and really understand, be closer to it's okay to have your engineering in Chennai, but the founder himself or herself should be where the customers are to get that touch and feel and stuff. On the ground, yeah. But if you really want to be in India, then it's far easier. The reason for me to build for India was very simple. I could meet my customers and understand their pain, validate my thesis, and really see if I'm solving the problem or am I just imagining that I'm solving the problem. And I did not want to make a copycat or a Me Too product. I did not want to make a product with somebody else said build. So this allowed me to do that bit. So if that is what rings your bell, then India is now a viable market. Congratulations and well done. And you can actually build hopefully $1 billion revenue business, a SaaS business out of India itself. By the way, we don't have a $1 billion revenue SaaS business. I mean, if you discount Zoho. But yeah, hopefully next 5 years we have one.
Interesting. So Ladal talked about, what you cared about. Coming to you, your former business also has a social impact to it. with the revised definition of MSMEs, I think the number is not even 63. I think it will be close to about 80 million MSMEs that you're, talking about, which employ, people down the line and millions in employment. So making insurance accessible to MSMEs, is that more of, a meaningful milestone for you to chase them?
Yeah, for us, at the end of the day, okay, 63 million sounds like a very nice number. Yeah, right. But this also includes single, this also includes a Pranwala, right? This also includes your small stores, right? Extremely small guys, right? The real number, I think, is going to be close to about, 6 to 7 million, SMEs who actually have a sizable, actually have employees which are more than about 3 or 5 in nature, right? That's really the truth. And I think one thing that Indian startups thrive on is that, we are 140 billion, 1.4 billion people, and we have a very large spend. No, it's not a very large spend, right? We all have smaller times only, right? But yeah, I think one of the things that we are able to do is that even if the TAM is compared to all other markets, our TAM is still much larger when it comes to SMEs who can actually afford to provide a solution. Second is the fact that, when we think about providing a solution to our SMEs, we have been focused making sure that we provide in a way that it is affordable to the SME, right? That's why we came up with a whole monthly subscription kind of a feature, because today India is an annual premium market today, right? Onsurity said that if we have to go behind a market which is going to be SMEs, we're trying this for the first time, right? We need to reduce the friction for someone to adopt to a new technology, right? If I had to go behind, automating my accounts, right? Moving from a person writing my accounts to a software writing my account, right? It had to be something simple. It had to be something that, I can do it myself, right? And that's where we kind of, pick up our inspiration, saying that how can we ensure that someone who's buying it for the first time does not even know it is going to hit them or not, right? Can we give them an easy exit strategy, right? This is very contrarian to any kind of a tool which says, why would you let your customers go out, right? But we also understood that if we stay true to our vision, once an employee benefit that has been rolled out, it will never be rolled back, because an employee will always come back and say, last year you were giving me this, now you're not giving me this, right? So we said that let's make it so frictionless, right? That people should actually say, if I'm not happy, I can always go out of it, right? Put all the focus on the experience part of it, right? So from that perspective, we said that if we are able to drive some of these things, we will always be able to retain our customers. I think the group doesn't know this, but Nikhil has been one of our customers for the last 5 years, right? And Nikhil's company has given us many opportunities, be it from an employee perspective or from an embedded perspective. So yeah, always good to see customers on the same roundtable.
Yeah.
You can take that example.
we had given insurance to every resident of ours, actually. That was Unsurity's embedded insurance during COVID period, because there was a tough time for everyone and not everyone was covered by their employers. So we had given every Zoloite insurance and Unsurity insurance embedded in our rental stay.
Interesting. Keshav, coming to you, you say you have, students in different countries, 60, 70 odd countries. So in your case, does going global, help? Does it give you better unit economics? How does it work out?
So absolutely. I think, being in the online schooling space, we are not restricted by the geography for sure. But I think our current mindset in terms of just being mindful of capital and business economics, we want to build for India, because India itself is a very diverse, challenging market space. The regulatory challenges are here, especially in the education space. Though I heard that in the capital market it has eased out, but not so in the education space for sure. And plus, the dynamics of the Indian parent, right from the north, south, or the different geographies, different backgrounds, is very different. So if we can create a good schooling experience for India, and you perfect that model, and build that craft platform and everything around the Indian market, it'll be much more easier to take a model to the global space, which will really work. I think, because obviously, I think outside India, the global markets, especially where the public schooling is still not sponsored by the government, like the Africa, Middle East, Southeast Asia, the large number of non-English speaking countries, we still are struggling to provide quality education. So that opens up a market. But maybe a couple of years down the line, that's where we're looking at exploring it.
Interesting. Vineet, I will let you have the last word. I started with collaboration, partnership. In your case, can partnerships with banks, NBFCs, wealth managers prove helpful? Can it reduce the, cost of customer acquisition, help you scale better?
No, so definitely, see, as I said, we are in the business of investment, and anything which will reduce the time for trust is beneficial. So if, say, we partner with a known NBFC or a known organization, and a customer is finding about Giraffe through them, so the time they take to trust us gets reduced substantially. Okay, so definitely all of those things help us. But the real cost benefit, I think, will come on integration. Okay, where the KYC cost, customer acquisition cost, all of these things, once it gets standardized, the CAC will reduce further, and I think the amount that the investors are investing will increase substantially. Right. So obviously these partnerships, also education and awareness, also because alone as a company you cannot do a lot, but once you have partnered with like 10 people and all of them are talking about it, so then the awareness increases substantially. Yeah.
Great. Thank you all so much for this candid and spirited discussion. We've heard today, that there is no single playbook for founders, whether it's in the EV space, co-living space, SaaS, fintech, edtech, or even health tech. Each journey comes with its own version of the founder's dilemma. Do you sprint towards the unicorn status, or you pace yourself towards resilience? That's the question that will always be asked. To our founders, thank you so much for sharing all your scars and the successes. That matters. To Sumit for bringing in the investor's lens. On that note, let's keep the conversations going beyond this room. Maybe talk about the winter jacket, because the dilemmas don't end even if this roundtable does. Thank you so much.
Thank you.
Thank you.